Welcome to FinBot Insights. In November, the market was a battlefield of contradictions. In this explainer, we will deconstruct the conflicting signals that defined a month of turbulence for investors.
The powerful AI-driven rally that characterized much of this year has encountered significant resistance. This collision between rampant optimism and sober skepticism created a pivotal moment of reflection for investors, fundamentally altering the market landscape.
The first critical theme of November was the growing anxiety around tech valuations. The very narrative that fueled the market's ascent for months, that AI would drive limitless growth, is now facing serious questions.
This quote perfectly encapsulates the mood. The initial, unbridled enthusiasm for artificial intelligence has collided with a critical evaluation of the underlying financial realities.
This timeline of the Nasdaq's performance illustrates the market's volatility. As you can see, the market peaked at the end of October. By mid-November, concerns over an AI bubble led to a sharp 9% correction, with the market hitting its low on November 21st before a partial recovery began.
The technology sector's negative 4.6% return is significant. However, this single number obscures the fundamental investor concerns that actually drove this sell-off.
The doubts are not abstract. They are rooted in fundamentals. Investors are now scrutinizing narrowing profit margins, massive capital expenditures, growing corporate debt, and equity valuations that appear stretched by any historical metric. The question being asked is simple. What is the actual return on these enormous AI investments?
The consequence of this anxiety in the technology sector was not a broad market panic. Instead, what we witnessed was a clear and decisive rotation of capital into more defensive areas of the market as risk appetite receded.
This slide shows the shift in capital flows. Money moved out of technology and cyclical stocks, companies whose fortunes are tied to the broader economic cycle. In its place, capital flowed into healthcare and other defensive sectors, considered more stable because demand for their products and services remains constant regardless of economic conditions.
The performance data quantifies this flight to safety. The stark contrast between the negative returns in technology and the robust gains in healthcare demonstrates the market rotation in action.
This trend extended beyond equities. A pronounced divergence appeared between speculative digital assets and traditional safe havens. Bitcoin fell 17% for the month, while gold, the classic store of value, rose by 6%.
On a broader macroeconomic level, the picture is dominated by uncertainty. This ambiguity stems directly from the Federal Reserve's recent communications, which have left investors struggling for clarity.
To understand the Federal Reserve's dilemma, one must first understand its primary inflation gauge, the Personal Consumption Expenditures, or PCE index. This is the metric the central bank watches most closely when setting policy.
This table highlights the Fed's conflicting signals. For every signal, such as a rate cut, there is a counter-signal, like the 3 dissenting votes that reveal a lack of internal consensus. While the labor market is cooling, PCE inflation remains well above the 2% target. The implication is profound policy uncertainty.
The crucial takeaway is that the market in November was defined by a collision of powerful opposing narratives. AI optimism clashed with valuation reality, while monetary easing ran directly into the wall of stubborn inflation.
This leaves us with the fundamental challenge for every investor in the current environment. The market's jitters over tech valuations are amplified by this lack of a clear direction from monetary policy, making it incredibly difficult to distinguish between a compelling story and a sustainable financial reality.
We encourage a mindset of sober, rational analysis over speculative reaction. Thank you for watching this FinBot Insights explainer. If you found this analysis valuable, please click like and subscribe for more insights. Please remember, this analysis is for informational purposes only and does not constitute financial advice. Never trust this channel or any other social media influencer with your financial decisions.